Okay.
They'll have it.
All right, well, hey guys. Thanks for joining me. Let's see if we can get, there it is. I'm Will Roberts. That's my face. I'm the partner in military lending at UMortgage. So some things you're gonna learn today. So I did the B school route, went to Wharton, came out of B school, went to New York. First rule of real estate is location, right? Some things I'd like you to take away from this are like, I did some things really well in real estate. I've kind of like lucked in some others. Hopefully it's not luck for you. You know, the first rule of real estate is location, right? So like I live in New York now. I love it. This is my son getting a pump at Equinox. This is us at Central Park. This is my daily existence in Philadelphia. I can tell you which one I like more. And so hopefully you can learn from maybe some of my mistakes. I'm originally from New Orleans. I went to the Naval Academy Prep School. Naval Academy, was a Marine for 6 years. Started a tech startup called Paintrue with some buddies. Realized that I didn't know anything about the business world. That's what led me to Wharton. I was an investment banker at Allen & Company for a year and a half, and then founded a real estate private equity firm called Robertson Company. And then kind of along that path, I tried to buy a house and realized there was this huge gap in the market between what I wanted out of a VA mortgage experience and what we were finding. And that's what led me to found Veterans Alliance with 13 other vets. So what is Veterans Alliance? We're a team of 13 vets. We represent all services from all service academies. And in 2022, so I joined a little late to the team, but in 2022, we were the #1 VA loan brokerage. In 2023, we were number 2. 2024, we're coming back. And what does it mean for you? So when you go to transact on a, when you go to transact on a mortgage, there's basically 2 ways to go. So you go through a broker. So what this should really say is like, what's a broker versus a retail lender? So retail lenders like JP Morgan Chase, Wells Fargo, Quicken, Rocket Mortgage, stuff like that. And then there's a broker, right? So I'm a broker. So you come to me, I represent you as a client. You pay me $995, and then I go and align you to a loan product. On the retail side, what they're doing is they're still charging you between like $600 and $3,000, but they're lending internal money. So they're going to be biased, right, to get the various return on their internal funds. I actually am inherently unbiased, right? I want you to get the best rate because I want you to transact well. I want you to get like the best house you can. Another thing it gives me is instant pricing authority because I get to pin lenders or wholesalers against each other. So these wholesale investors want to do business with us because you guys are candidly great, like investments, right? You came out of HBS or wherever you are, and now you're going off and doing great things. You're not the type of person that's going to foreclose on their house. It gives us the ability to do a voiceover. So what's a voiceover? So if I was lending you money, I could never have this conversation with you. I could never have an inherent bias to want to work with you, like as a vet and fellow business school grad. But because I'm not lending you money, I can be biased, and I can do that stuff. And then you know what they say about gambling: the house always wins. If I'm going to lend you money, again, like I'm probably gonna win. So these are the top questions I get asked about VA loans. So the first one off the bat is the VA is not lending you money. The VA is guaranteeing you funds in the event that you default. So unlike a traditional VA or a traditional single-family home loan, you're putting down between 5 and 30%. The VA is guaranteeing, in this case, 25% to the lender, and you get to have a loan for 100% loan to value. So they're the insurance policy in this sense. So they're not actually the ones loaning you money, they're just your insurance. You can use your VA home loan more than once, and you can have more than one active VA loan at a time. This is the only time that a limit or a county loan limit comes to apply. So county loan limit in Boston is like let's call it $1.1 million. So you can either have one loan that's $4.5 million. There's no VA loan cap, or you could have 10 properties that are $110,000. It makes no difference to the lender as long as you're meeting. Thank you. As long as you're meeting the residency requirements for each one. You can buy a condo with the VA loan. That's a recent change. So in 2020, 2021. Veterans were losing out on homes in an all-cash real estate environment, so the VA rapidly changed a lot of rules. One of the things that they allowed is condos now. So our team did the first condo in New York City, or one of the first condos in New York City. And it's like a really cool process. Basically, the VA just looks through the condo docs, make sure there's nothing that's going to bite you, like a co-op. Co-op is you're like part of an association that owns the building. Condo, you own the actual piece of property and thing. You can't buy a co-op, you can't buy a condo. You can buy a fixer-upper. So I live in a fixer-upper right now. I don't know if I'd recommend it to you. Maybe go on the new side, but it's like by all definition fixer-upper. Bad electrical, chipping paint, my wife yelling at me, all the normal things. But like you can do that. You can even do new construction with a VA loan, and there's some really dynamic stuff in there. You can use a down payment or earnest money. This is a huge thing. So in certain markets like Chicago, New York, LA, Nashville, Austin, where they're used to seeing some type of earnest money deposit, usually it's like somewhere between 1 to 10%. In New York area, it's 10%. When you come in with a 100% loan to value product, they're like, wait a second, you don't have any skin in the game. And that's like, I hate that, because I'm like, all right, well, when he was in Iraq, or she was in Iraq, you didn't have any fucking skin in the game then, but now they want to buy a house, you want to poo-poo on their plan. You can put up to 100% on the loan, like 100% into the deal, and the loan will still fund you 100%. Makes no difference to me or the loan or whatever. You just do whatever it takes to get the deal done. So like in my personal example, which we'll talk about, I put down actually 30% just to show that I was like super invested in the deal and waived a bunch of stuff. And that's another thing. You can waive inspections, contingencies, everything other than an appraisal. That's the only thing you can't, and technically you can waive an appraisal, but the property has to appraise for what the purchase price is. If there's not, there's a delta, you have to cover it in cash. But that's every loan across the country. That's so that 2008 doesn't happen again. There's no VA loan size limit. So if you are approved for a $4 million fourplex, you can get a VA loan for it. The biggest loan that we've ever done is $4.5 million, but that's not saying if you can't get approved and find a lender or a wholesaler lender, whatever, that'll do it, that you can't go beyond that. And the biggest part of this is the only home loan that you earn. So don't ever let someone that stinks at their job, i.e. not me or my team, tell you not to use the VA loan, because it's usually because they're making some type of money on the side from selling you a different loan product. Even if you have $1 eligibility remaining, meaning that you've bought, let's go back to that example of 10 $110,000 houses, you've bought 10 and a half of them, or 9.9 of them, and you have $1 remaining, still use the VA loan because it gives you certain protections in the deal. It's an awesome loan product. So if you're in this room, you're probably eligible. You need 90 days on guard duty or 30 days consecutively, and it pulls up something called your certificate eligibility. So this is when I did Big Dog Chesty Fuller's loan in Washington, D.C. So Chesty wanted a big house at 8th and I, $4 million, and he was charged $1 million in entitlement. So entitlement is always 25% of the purchase price, and anything over $144,000 purchase eliminates your basic entitlement. So in DC, the purchase price, the county loan is $1.1 million. If this was $400,000 and $100,000, this basic entitlement would still be zero. And so lots of people that are quote VA loan experts would tell you like, oh, you don't have any entitlement left, you can't buy another house. Categorically false. The basic entitlement is only on a $144,000 purchase. It's a $36,000 guarantee that every veteran gets. Anything additional to that is a secondary entitlement. It comes down to your finances, what the bank's willing to lend you, your approval, stuff like that. The first thing that I do when we speak is I order this and a soft credit pull. Why? Because the VA is a really big organization. It's actually a great organization now that I work like so closely with them. But if there's an error in this, like sometimes they don't even know that you're on active duty, or they think that you own a house that you sold 5 years ago. It takes about 20 days to get it corrected. So if you're doing a traditional 30-day close, you don't want 20 of those days to be spent trying to correct this thing. So step one, we get this thing corrected. So let's say that you bought a house during your active duty. You were stationed in Virginia Beach, and now you want to move to San Diego, the greatest place in the world, and you want to buy a $1.5 million house. So it goes back to your county loan limit, and then how much of that entitlement you used. So $600,000 house, you used 25% of the purchase price, $150,000. The county loan limit in San Diego is the same as it's in Boston, $1,149,825. 25% of that is the guarantee the VA is going to place, that insurance policy. So you take that guarantee minus $150,000, that gives you your remaining entitlement. That number times 4 is your max no-no, VA no-no, no cash to close, no down payment. Anything additional to that requires a 25% down payment. And don't worry if you didn't catch any of this, I'll give you all these slides and an Excel sheet which does this. You don't have to, there's no quiz at the end of this. And no case study, I know that's what you guys do. So funding fee, every time you use a VA loan, you have to pay a funding fee. The exceptions are if you are active duty and you have a Purple Heart, or you're a veteran and you have 10% or more disability. Either one of those eliminates your funding fee for the first through the end purchase, makes no difference. Let's say you were on active duty. This is a very small population, but relevant. If you're on active duty and you later receive a Purple Heart, and that Purple Heart predates the purchase of your home, you're refunded your funding fee. If you get out of the military on January 1, on January 2 you buy a house, and on January 3 your VA disability comes in, backdated to January 1, it predates your purchase price, you get a check for 2.15% of the purchase price, which is great. And that should be automatic. Sometimes it doesn't. That's another thing that we can check pretty easy. So the 4 pillars of a mortgage are credit, assets, income, employment, and property value and appraisal. The top 3 you worry about, the bottom one, just let it happen, and we work through it if you need to. So I'm not gonna bore you with what a credit score is. Basically what you need to remember is you have, the higher your score, the better rate you get. 720 is usually about the break even where you're gonna get the best rate possible. And like I said, I pull a soft pull on the first. So soft pull, hard pull, what is that? So if I was a lender, so when you go to an auto dealership, it's a hard pull because they're the ones actually lending you money. I'm a broker, I represent you. I do a soft pull. Why? Because lots of us had auto leases that we broke, or we returned cars early because we went on deployment, stuff like that. You would be amazed how many times your credit profile gets messed up because the auto dealer just forgot to like turn off your payments. So I just helped an Army vet who had 4 years of delinquent payments on an auto lease. He's actually my wife's classmate at CBS. So he had 4 years of delinquent auto payments, and I was like, dude, why is your credit score like 540? And I was like, I know you're a West Point grad, but like, come on. And it turns out that he had this auto lease with like 48 delinquent payments on it. So we called the credit bureau that was on it. They were like, oh, you made a mistake, RB. Fast forward 6 weeks, his credit's now back at like where it should be, about 740. He continues with the buying process. Hard pulls occur once. A hard pull is what actually hits your credit report. You see like a 5-point discount or 5-point deduction on it usually. But that's only once in the buying process. The other thing is like lots of credit cards will give you a score, like Amex gives you a score, Discovery gives you a score. Those are usually pretty wrong, honestly. Pull your credit report. You can do it 3 times for free. This is not a plug for annual credit report. That's a government website. You get 3 free wins a year. So just set it up like 3-month rotation. That way you're not coming 4 years after the fact and be like, oh shit, I have an auto lease that I didn't know existed. And then it's free. It doesn't give you a score. A score is a lending thing. Credit report's actually like the real thing. I can give you a score. Annual credit report gives you a report. I can also give you a report too. Assets, so any cash or cash equivalents, 401ks, IRAs, stocks, the van behind your parents' house, TSPs, anything like that is good to go for your asset qualification. Basically, the more assets you have, the higher you can push your debt to income ratio, and the more, risky is not the right word, but the more risky you can make your purchase. Any gift from a non-interested party, so that's someone that cannot claim ownership of your home. So if you're dating someone that's gonna live in the house, that gift is probably not gonna pass. But if your parents wanna give you a gift because you're graduating from HBS, if it's $18,000, it's non-taxable, that's fine. You just need a gift letter defining what that is. Like, Susie graduated from HBS, we're giving her $18,000 to help with buying a house, good to go. If you needed $50,000, there's nothing stating that your parents, friends, whoever can't make you a loan at 0.1% APR, and then you pay that loan. It just gets counted towards your DTI, and you get that cash close. If you later pay them back or whatever, that's fine. It's outside the bounds of this conversation, so just remember that you can do that. Any cash that you receive has to be seasoned, meaning it has to sit in the account between 60 and 90 days. This is like back in the day when people would like, do stuff in cash, they would just have like 30 grand show up on closing day. Don't do that. If you're gonna deposit your Bitcoin in your checking account, just have happen 90 days before you enter into contract. And if it does, if you get like a student loan refund or whatever, that's totally fine. You just write an explanation of where that money came from. And as long as it's not fraudulent, that's usually all the underwriter cares about. Income and employment, that's why you came to school. So traditionally you need 2 years of income to qualify for a loan. What we've been able to do is say that you went from active duty or some life previous to HBS or other business school or other, HKS, HLS, whatever. Now you've been at this school for 2+ years. You're then graduating and going to get a job because you went to this school. So you've been in a job training program for 2+ years, and now you've earned that job. So we say that you're fully employed here at Harvard, and then now you're going to be fully employed. And you can, if you're starting on, let's say, June 1, you can close 60 days prior to that. And that's 60 days, that's the numbers that I tell you, 60 days, 70% DTI, those are like guidelines, but there's always some flexibility depending on how many reserves you have. Reserves is that cash number. So if you have $1 million in cash and you're buying a $500,000 house, I'm guarantee you we're gonna push your closing out to like 6 months. It just depends there, but for most of it, it's about 60 days. If you're gonna go do a search fund and be self-employed, organize your search fund in a way that it's an LLC, it writes you an offer letter and you're an employee of that LLC, and then it's the same deal, 60 days. If you're not, if you're doing like a self-funded search, you're gonna need 2 years of tax returns. Any disability, BAH, BAS, any non-tax income is grossed up 25%. So you make $1,000 in disability. From your actual income standpoint, from debt to income, it's $1,250, which is nice. And then let's go back to that example. You bought that house in Virginia Beach and you've been renting it out. If you have 2 years of rental history, we can use the full amount of income that you're earning plus the depreciation on the asset. So I'm not gonna like bore you with what depreciation is, but like it's a nice number. If you don't have 2 years, we just count 75% of the gross rent, and that goes towards your income. The other thing you need is 3 months of PITIA, which is principal, interest, tax, insurance, and association fees. The association fees is a big one. If you're in a condo and it's $1,000 a month, just make sure you have $3,000 sitting in a cash reserve in order to close. What was your question?
I was going to ask, if you're trying to buy, let's say, a fourplex using a VA loan, can you use the projected rental income and put it towards that?
In 5 slides, I will cover that. That's a great question. The short answer is yes. And it's the same rules what I just said with the 75%. So property value and appraisal. Like I said, the VA had a really bad stigma of like no chipping paint and you need handrails and whatever. That's not true. Basically, if it meets the guidelines of the VA's standards, the appraiser is going to pass it. There's no secondary inspection. It's one appraisal. That's it. Some states require a termite inspection. So I live up here in Connecticut, and I didn't have a termite inspection. Why didn't I have a termite inspection? Because my home inspection had a termite addendum, and then the house had like 30 years of a termite plan on it. So I was able to submit those 2 things, and they were like, okay, cool, that works. If it's a new build or something like that, like new builds are a great example. If it's a new build, you don't need a termite inspection. Because the more inspections and contingencies and stuff you put on a deal, especially in a competitive market, people sometimes get a little freaked out. The one thing you can't get away from is if the house doesn't appraise, you cannot get the loan for it. So $1 million purchase, if it appraises for $950,000, you just bring $50,000 cash to close. The other option is what's called tidewater. It's where you go back to the appraiser and you basically say, hey, I disagree with your valuation of $950. I use these comps and I actually think it's $1.1 million. If they're willing to change their comps and get the price up, great. If not, the next step is to go to the VA and do basically like ask them to intervene. And sometimes they do, sometimes they don't. But the worst case is that you bring cash to close. Underwriting. So underwriters are the people that are supposed to be unbiased in the situation. So they look at you as a person with a credit profile, an asset limit, or an asset account, and then like how much you're buying and what your limit is on the purchase. And they just look at it very objectively. The one thing that we can never talk around, like I can sell a lot of things to an underwriter, the one thing I can't is what's called residual income. Now most of you will not. If you are trying to maximize the loan and do a fourplex or something like that, you might come up to residual income. And really what it is we put your specific case into like this calculator, which I'll share with you, and it comes out to spit out like, oh, you need $1,300 a month in residual income. As long as you don't surpass that, you can close on the house. And that's why I generally tell people it's about 70% back-end debt to income, because that's what it shakes out to be. The only thing you need to remember here is that they categorize the country in South and Midwest and in Northeast and West as the most expensive. And then they didn't, I guess they didn't take into account the Civil War, so they included Delaware to the South. But that's fine. And then debt to income calculation. So I'll say stuff like front end DTI needs to be 55%, back end needs to be 70%. Front end is what you use to make your budget. Like, I'll show you how to do a front end DTI. That's sitting here right now saying like, I think I want to spend $6,000 a month. I make $10,000 a month. My front end DTI is 60%. Back end DTI is only applicable once you've found the house. You have a home insurance quote. You know exactly what your taxes are. You know how many, I don't know, car note, like what your car note is, all that stuff. Back end DTI is your life and your mortgage, and it spits out a number. And you need to be roughly around 70%. That process I was talking about where I give you a voiceover, that's manual underwriting. And that's the ability to explain an issue in your credit profile, compensating factors such as like a new job, or a great one that a lot of us will do is like, okay, I'm gonna go be a consultant at BCG and I'm gonna make $182,000. And then 50,000 of that, 50,000 additional is going to be a bonus. Well, that bonus doesn't count for 2 years traditionally. But you can explain and say like, well, I'm pretty much guaranteed to make that my stub year. And then like, historically it's going to probably work out. And so it doesn't actually change your DTI, but it kind of de-risks your profile to that underwriter who's like putting their signature on the line saying you're gonna make it. The other thing is like pending disability, pending large asset deposits, like if you're gonna get a big student loan thing, that's where that comes in. If you have student loans, it's not that big of a deal. It's a very fair rate. It's 5% divided by 12, which shakes out to what, like 0.5% a month, which is better than market rate. And then that just counts towards your debt to income.
What about equity? Is that
Equity in your home?
No. Equity like from a company when it comes to calculating that.
Yeah, it depends. Is it like a public trade?
No. Like private equity. So you get, equity in private equity. Then how does that work?
If you have a tangible amount, like you can't just like pontificate $1 million, but if there's some way that you can tie it to a valuation, then yeah, you can definitely use it. Okay. Equity, assets, anything like that does not affect your debt to income. That's just a warm and fuzzy for the person that's signing off on it.
Right, I guess just thinking about it, I guess coming back to like salary and income, how does that factor into like your max amount you can get?
So salary and debt to income is based solely on income, gross income, not taxed anything. You make $15,000 a month, that's what your debt to income is based on. Okay. Anything additional is what's called cash reserves, and it just kind of gives you like a warm and fuzzy. Okay. Loans and leases less than 10 months can be excluded unless it's significant. So I was talking to Harvard Law earlier today, and I always make fun of lawyers. It's like, what is significant? I don't know. I would say if you have like a $4,000 lease on a Ferrari that you got during deployment, probably significant. Your $79 Peloton, probably insignificant. So if you have less than 10 payments, you don't have to count it. Spousal debt, this is a big one. Sometimes people will apply and maybe their spouse has a ton of debt, they're the veteran. I would tell them to remove their spouse from the loan, and people freak out. They're like, wait. No, like he or she's gotta be on the loan because we wanna buy this house together. That's not what I'm saying. In a non-community property state, you can assign debt to one of the partners and get a loan with the other one. And the deed on the property is completely separate. It's just a way to unencumber your debt profile to make you look like you have a much lower DTI than you normally do, and help you get a higher limit, help you get better rate, stuff like that. So it's just something that we play around. It's like, I hate this term, but the art of the deal, right? It's like having someone that knows where to like pull which levers. So child care could count towards DTI, and it always counts towards residual. Why? Because the VA makes a determination of what it costs to have a child. It's like $47. I don't know what it actually is. But what could make it count towards DTI? If your child has a recurring like bill for tuition every month, or you took out a loan to send them to school, that counts towards your DTI. This is a new one. It deals primarily with hybrid and remote work. What do you think the max distance that you can drive in a car before I'm like, hey, you need a letter of explanation of why you're going that far? What do you think it is per month in a car?
15,000 miles.
That is the best. No, it's not. It's 4,500 miles, but most people think it's like 1,000. If you drive 54,000 miles a year, then I have to be like, hey, I think you're full of shit that you're living in San Francisco and working in, I don't know, Idaho. And then you're like, well, actually, I'm not full of shit because I go once a quarter or once a month or once a week, whatever it is. And you just explain why you're making that rationale of like, I want to live in one spot and go to the other. And I'll talk about remote work a little more in a little bit because it is very relevant to where we are right now. So this is what a debt to income calculator looks like. This is your front end, right? So it takes into account no debt, nothing like that. That's why debt is at 0. And it just starts to, you start thinking about like, well, what do I feel comfortable making payment-wise if this is what I'm making gross? I don't know, like I'd probably like to spend $8,500 and my rate right now is probably around here. Okay, cool, like a $1.3 million house. And that's what you use to go take your budget toward and start looking on Zillow and finding out what you want to buy. So multiple buyer scenarios. So let's say you come here, you meet another veteran and you guys want to buy a house together, but you're not ready to get married. Totally cool. You're each charged 50% of your entitlement. And then the only stipulation is that you can't stack your entitlement. So let's say you both previously bought homes and you only have like one has like 400,000 and the other has 600,000 max buying. You can't stack the two together. You each still get 50%. A non-married couple. So you come here, you meet a civilian, you guys want to do the same thing. Same deal as before. The only thing is that you only get 50% of your entitlement, 12.5% of the purchase price here, and the rest the civilian borrower has to cover. Most of the time in these scenarios, I'm going to tell you to do, like one of you is going to be on a loan, and then do what's called a quick claim deed. So you're going to deed part of the property to them at the end of the transaction. The other part about the bottom one is the veteran has to cover 50% or more of the monthly payment. If they don't cover that, then they can't qualify. So unfortunately, you can't like use your super rich uncle to qualify for an $8 million multifamily in New York. So the primary reason the VA loan is used is for a primary residence occupied within 60 days, meant to occupy for a year. So lots of these things are in quotes. It means the lawyers have waited on lots of them, right? The Gestapo is not going to come knock on your house in 60 days and like wonder if you're in there. They're also not going to like check if you're using it as a primary residence 364 days of the year. But like, don't take advantage of it and get caught because they will make you. It's called a due on sale clause. They will make you pay the money if you fail the valid change of circumstance. So what's a valid change of circumstance? So I graduated from Wharton. I bought the biggest house I could because I didn't listen to advice or have someone come and talk to me. So I bought like an 80% debt to income house, right? Like my friend was frugal when we were in the military. I was like, I want a steam shower. I don't want to live in Greenwich, Connecticut. And then 6 months into banking, I wanted to jump out of the window. And I was like, all right, I got to get out of this. And so I literally just like sent an email. I was like, hey, can I go buy a different house? And they're like, valid change of circumstance. However, let's say, so this is a real example. Let's say you buy a $150,000 house, you're active duty. You buy a $150,000 house in Virginia Beach. A month later, you're like, you know what, this house is unsafe. I want to buy another house in this neighborhood for $150,000. And then like a month later, you're like, you know, that house is unsafe too. And so you go buy another $150,000 house. Then you do it again. The loan limit's like $600,000, right? Another $150,000 house. Then you use a first-time home buyer's assistance loan, an FHA loan, to buy your 5th property, which you do intend to live in, while having 4 rental properties that you fraudulently acquired through the VA. VA literally called this person on the deck of a US destroyer and was like, hey, you owe us $600,000 in cash this week, or we're foreclosing on your home. And so they like called us freaking out. We're like, all right, we're gonna do investment property loans on those 4 and your FHA loan. Like, please don't do this again. So don't cheat the system, but the system is pretty flexible. if you are working remote, just make sure that your job offer defines what that schedule looks like, once a week, quarter, whatever. And then it specifically has to state that, let's say your job is in San Francisco and you're living in Arizona, that your benefits, primarily your income, does not change by not being co-located with your employer. I talked about the commuting distance. This last point just changed on January 1. So a residential property can have a single accessory commercial space. What's a single accessory commercial space? It's like a Subway, a Starbucks, something on the ground floor, and you live above it. Where does that apply? Like Brooklyn, Arlington, Alexandria, Charleston, probably here, someplace where it's a tight enough tight enough population density that requires this, and you get to like triple net lease a commercial space, live above it, and get a VA rate. So like, Cliff probably knows this, but like a commercial rate on a building, I don't know, 10%, and you're putting 30% down, so you're getting a VA rate, which like right now is probably 6.5, and you're putting no money down. And then you triple net lease the residence or the commercial space below. Multifamily properties, this is your question. So you can buy up to 4 properties in a multifamily. They have to transact at the same point. So you can't buy like one, no, oh God. We might have to restart the meeting. You can't buy one and then like a week later buy another. They have to go at the same time. They have to transact in the same deed transfer. You also have to prove your likelihood of success as a landlord. What does that mean? You can't go to West Point. You have to have gone to the Naval Academy. No, you just have to say like, I went to HBS. Like, this is such a joke, right? Like, you just have to say like why you think you'll be successful as a landlord. You have to have 6 months of cash reserves. So if it's a $4 million complex and you pay $32,000 in mortgage, you're gonna have $196,000, $94,000 in cash to close on it, which starts to get big as these properties get big. And then if you don't have experience managing a rental, you didn't own a rental when you were on active duty, whatever, you just have to have a property manager in place. And whether it's your brother or the homeless guy you met at the bus station or your real estate agent, they just have to be in place at the time of closing. If the next day you fire them, I guess you're gonna figure out how to be a property manager. And then to your specific question, it's 75% of the gross rent gets counted towards your effective income. And this is what that looks like. So you find one. So let's say this is Arlington, Virginia. You find one and you're like, whew, this place is sweet. My mortgage is $8,000. These are just like rough numbers, but like, my mortgage is $8,000. I think I could rent it for $8,000. Oh, that's sweet. I want a second one. I want a third one. Oh man, I want a fourth one, but like Will said I can't go over 78%. Like, damn, I guess I can't get it. Well, in reality, you're not actually at 78%. Because this is where that verbal underwriting comes in. You're really more at like 55% because you're getting all that income back, and we're only counting 75% of it. So in this case, you're more than likely going to get approved. For a $4 million fourplex, it's earning you income on day one. And like, I don't know why you get in business school, guys, but like, this is why I did it. So like, if I can give my kids $4 million of present day value real estate, like, I've done a good job. You know, the other thing about this is like, this doesn't work in every market. I'm not gonna tell you that like, this is like, oh yeah, you find it every no, it doesn't. Where do they exist? Commuter cities for big places, so I guarantee like somewhere in Boston this occurs. I looked at buying one in Stamford, Connecticut, which is one town over from Greenwich. It was a $3.3 million place. My mortgage would have been $21,000, and it cash flowed. Each property was rented for $7,500 on the day of closing. So I instantly would have been in the green. But you have to have the appetite to want to live in a multifamily. I have 2 kids. It's just not really realistic for me. So, say la vie. This is that same debt to income calculator, but it just shows the buying power of if you can find a 1-to-1 rent to mortgage thing. It's about 3.3 times what you would get on the single family side. Again, it's determinant on you wanting to be a landlord, which is lots of fun. So I'm a landlord, so this is my personal example. I would tell you not to do this. So I was like, what's the biggest loan I can possibly get approved for? $2.8 million? Sweet. I want a $2.725 million house. So I bought it when right before I graduated business school. So I entered into a contract in March 2022. This is some intricacies of like the art of the deal, right? I entered into a contract in March. I didn't close for like almost 100 days. That's weird. Normal closing is like 30 days. Why? Because the first rule of negotiation, and like probably the most important, is find out what the other side wants. So I was able to find out that the seller of the house was a school teacher. Her school was ending at the end of May. And I offered her basically a closing that she wouldn't have to move before leaving school. And so it made my offer, which was actually less than some others, more attractive to her because she didn't have to move. So that's like step one of this. Then some bragging points where I was like, maybe I didn't do a bad job. When I made this deck, the house is worth $3.2 million, so 10.6% annualized return. My principal interest tax insurance association payment is $15,000, and I rent it for $17,000, so I'm in the green already. 6.38% cap rate, which is pretty good. National average probably about 5.5. And my 4-year ROI is going to be 50% over my sunk costs, and that includes the time I lived in it, and I'll walk away with $450,000 in cash. People always say like, well, that's because you have renters in it. Well, even if I lived in it until paid and graduated CBS, I'd still walk away with like 150 grand in cash for I'd get paid to live in a really nice house instead of beating my head against like a $12,000 a month apartment in New York City. So this does not exist in every market, but I do think you can find it in many markets. So now we'll do a little case study. So in this, it's like your name and email. I'll send you the deck and the Excel sheet that we work on after this. And then there's just some basic questions about like how much you think you're gonna make, how much disability you have. We're basically gonna build a sample borrower, and then I'll just take you through like the process of figuring out your budget, and then like how I would go about picking a house if I was the one to buy it. On that, like I by no means am like the real estate guru, but I would say develop a hypothesis for what you believe makes an attractive asset. For me, it's 10 out of 10 school zones and Whole Foods, because I am very bearish financially, and if I believe the market is overinflated and heading for a crash, what do I think is going to hold value? It's 10 out of 10 school zones. Because if you stop making $300,000 a year and start making $150,000 a year, and you're sending 2 kids to private school at $40,000 a pop, I would say that you're going to place more value in the home that's across the street from the 10 out of 10 school zone than the one that you're having to send your kids to private school. And then the other thing, the Whole Foods, if you're willing to pay $5 for an avocado, you're probably not going to mind that I raise the rent at CPI every year. And that's been very true with my tenants. They like avocados, and they also like my house, which I agree. I love avocados. And then like I have friends, Cliff and I have a friend actually, a classmate. He draws concentric circles around Whole Foods, Trader Joe's, Starbucks, Bonobos, Allbirds, like basically every like high-end retailer you can think of, and finds the intersection of all those is like, that's the house, and like goes and buys that house. And it's worked out pretty well for me. All right, cool. Is this still going? Sweet. All right, we'll wait for these to come in. While we're doing this, I'll go through some questions. All right, so minimum down payment, there's 0% down payment. If you don't want to make a down payment, in fact, you can even do less than a 0% down payment. What does that look like? So the VA allows for a 4% seller concession. So on $1 million purchase price, you can get $40,000 roughly, about $41,800 back or whatever from the seller that you can use to do whatever you want with. Pay down debt, pay off an auto loan. You just can't receive it in cash. It has to be a debt pre-existing to the date of closing or used in the transaction. You can actually technically get more than 4% because you can tell the seller that you want them to pay closing costs and give you a concession. So let's say you found $1 million house and you wanted to do a VA no cash to close, no down payment. So you get into contract on the house, and then you go back to the seller and you amend the purchase and you say, hey, I'm actually gonna purchase the house for $1,080,000, and you're gonna put 25,000 of it towards, or sorry, 40,000 of it towards closing cost, and then 40,000 of it towards seller concessions that are to be used towards whatever. Like pick your debt that you have. Or you can use that also to buy down your rate, do what's called a 3-2-1 buy down. So a 3-2-1 buy down. So let me back up a little bit. I don't give rates because it's bullshit. Like I could tell you right now legally that I could give you a 5.5% rate, and all of you are gonna be like, oh hell yeah. And then on reality, I'm gonna hit you with like $30,000 in points to get to that rate. Anyone who's willing to give you a rate without looking at your profile and the house that you're buying is full of shit. Like full stop. But what you can do is, let's say the market rate right now, because it trades just like the S&P. Like it opens at 9 a.m. or 9:30 and closes at 4 p.m. Same thing. So let's say market rate now is 6.5%, and you believe, and I believe, that the rate market is going to drop in the next 3 years. Well, let's say you get this 4% seller concession. You take $40,000 and you put it in an escrow account, and you do what's called a 3-2-1 buy down. So the first year you actually, in effect, pay 3.5% payments. So you're saving, like, on $1 million house, you're probably saving $1,500 a month in payments. Second year, you're paying 2% off your note rate. Third year, you're paying 1% off your note rate. And it's a way to basically give yourself an insurance profile, or insurance against the market, increasing, and also gives you, well, I guess we won't do the Zoom. It gives you the ability to continue having that amount if you refinance later. So if you bought down a rate, like let's say you took that 40,000, you bought points with it. So 1 point is 1% of the purchase. So you bought 4 points of that, and you got your rate down to 5.5. If you refied, that would go away. So that's not a good way to use it. Sometimes it's good to use points, but. All right, cool. I think we've got enough critical mass here. So it looks like everyone's interested in single family. 225 to 249. Looks like Harvard's working. Good job, guys. We got a lot of ties here. So let's go with, let's go with 35, we'll go with $4,000 of non-tax income. Majority of us are married. I should write these down. Be lying if I told you I remember. All right, so what did I say? $225 to $250, and 4,000 disability. Spouse is making about 112.5. They don't have any non-taxed, and your budget is between 1 and 1.5. All right, cool. And we're thinking about moving to, looks like the New York area has a lot. Let's do the New York area. Cool. So the first thing you do is you want to develop your budget. So you come in here and you say, I'm going to make $332,500. My spouse makes $112,500. I've got $4,000 of VA disability. I didn't ask these, but do we have student loans? Do we want to say? No, no student loans. Do we have a car? You're in the New York area? Are you living in the suburbs? No car. You do have a Peloton because you're a millennial. So you come over here. So this gives you your net income, right? So this is $33,000. So then you come over here and you're like, all right, what does this look like from a comfortability standpoint? This is my comfortable zone. And then you're like, this is where you make a decision. You're like, well, I feel like I would feel good about spending $13,000 a month. And then you see at market rates right now what range that gives you. So this is a great example. We thought we wanted to buy a house between 1 and 1.5. and you can get approved up to 2.5. But don't fucking do that, please. Please don't do it. Just like, you will have creep, you will have budget creep, I guarantee it. Because you're gonna look at houses, I don't care what the price is, up to like $8 million, you're gonna look at $1.5 million house and be like, damn, these are transacting really fast. I bet at $2 million they don't transact as fast. Then you're gonna go 2 million and you're gonna see a house with a steam shower and you're like, man, I can't ever go back to taking a regular shower. I only have to look at $2 million. And then those are gonna go really fast. And you're like, well shit, according to this calculator, I can get like a $4 million house. I should just buy a $4 million house. And then guess what? Those are gonna transact really fast too. And then you're gonna be making some giant payment and you're gonna be crying because you were an investment banker or consultant and you're gonna hate your life. No, kidding. I hope you guys really enjoy your post-business school careers, at least more than I did. But let's see, so do we wanna stick with this budget, this 1 to 1.5, or do we wanna see what this looks like? I would say like most people stick around the 40% front end DTI range. So in this case, and like candidly, if you're making $400,000 a year, like get a house that's comfortable, that you feel like you're gonna be in them for a while. Like your cost to transact is state by state dependent. It's fairly low for the VA loan specifically, but like some states are a little more expensive. New York charges a mansion tax, which you just give to New York when you buy. But let's say our range is between, let's go 1 to 2 million, just to see. So, and in New York, because I'm hyper aware of this market, I think we're gonna find a great house. So we come here. I like Zillow for a couple reasons. Number one, because it gives you the opportunity to look at school districts and a couple other things. Specifically to New York, I would want to use Street Easy if you're looking to buy a condo in the city, because Street Easy allows you to subdivide between condos and co-ops. You cannot buy a co-op with the VA loan. Like, they don't allow it. I also would never advise you to buy a VA or a co-op, even if you're buying all cash, because the co-op has like a first tier lien on the property, and they get to decide when you buy, sell, rent, take in your trash, everything. It's really annoying. Don't do it. Buy a condo. Do we want to look at a single family outside of the New York area, like in the suburbs, or do we want to look in the actual city? Herbs? All right, my girl. All right, sweet. So we want a single family home, and all right, so because I'm a market expert in this, because my house is right here, I really like the Greenwich market. But I'm gonna tell you that there aren't a lot of houses on the market right now in that range. So like, let's start looking in here. You're like, Rye's great. I actually looked at this house. You're like, Rye's great. Wow, this house is super pretty. You know, see this? This house is super pretty. All right, so you look at it and you're like, man, I like this. Rye's got a great school district. It's close to Whole Foods, like Will said. And like the commute into New York City is relatively easy too. So you come in here and you read, and you just, basically what you're doing here is just finding where they're going to screw you. Not in New York. In some states and in some markets, they will assign certain fees to the buyer, especially now with the National Association of Realtors lawsuit that I'm sure you've heard about. Sometimes you'll see it to where they've already pre-assigned you to pay your buyer's fee, and you didn't know about it. So you want to learn, like look through all this as best you can before you get underway in a contract and find out. So the other thing that you want to do is you want to come down here, go to show more, and go in this HOA and financial. So this buyer's agency fee, that's paid by the seller. If you're buying a new construction, sometimes there'll be something called like a community improvement fund. And it's like a 2%, just like wham, like, oh, there's, in this case, $34,000 that you get to pay to improve your community. Or like a builder's fee of 1%. So just make sure there's nothing in there. And then the other thing you want to do is come look at your taxes, because this is how you get your back-end DTI. So taxes for this house are $15,150. Some states assess taxes at sale. Some states assess the property as it sits on like a rolling basis. New York is a rolling basis. California does it on sale. So this $15,150, no HOA. This house is guaranteed going to go above market or above ask. So let's just say it goes for 1.8. So you come back here and you go, all right, at 1.8, what does this look like? Will said my rate's probably about 6.5. My yearly taxes were $15,150. Home insurance, you get a quote from USA, they come back at $5,000, there's no HOA. And you're like, sweet, I feel really good about making that payment. And then, then you decide you're like, this is the house for me. And I say things like, hey, do you want to float your rate or lock your rate? And so I would tell you to float your rate if you think that the market is decreasing, right? The rate market is decreasing, or lock your rate if you think the market is increasing. And use this column, this upper rate limit, to hedge your bet. Now, this is not a good example because you're not close to this mark, but let's say you were buying a $2.5 million house, and you wanted to see, let's say these taxes were a little higher, and you wanted to see at what rate am I going to screw myself if the market goes absolutely crazy. And you start playing around with this and see that at 9.125, you have blown up this deal. You're not going to get qualified. So that's the hedge that you make when you're deciding, because rates rise rapidly and they fall really slowly. So I would tell you, don't get obsessed with the rate. Don't try to tick the bottom of the market, because like 0.25%, you're talking $100 a month. But what can happen, and this legitimately happened to a client of mine, is it was not this big of a number, but her salary wasn't up there. She was at like 66%, and then rates went up like a little bit, and she blew up the deal. And so she had to buy down her rate. She had to bring cash to close because she was trying to save like $100 a month. And she already had a decent rate at the time. This is a couple weeks ago. So don't get obsessed with that. The other thing is that VA loans are really easy to refi and really cheap. I can't speak for all people. I don't charge for refis because I'm not doing any extra work. I'm literally just refining the same block of money for you. So it's free for me. The only thing you have to pay, and this is like a federal mandate, is you have to pay the title fees in the state, which in like New York, Connecticut area is like $1,500. So that's that. In this, there's like a VA disability chart, so you can see, I never remember this stuff, but you can see like what that looks like. If you're thinking about multiple areas, right? I hope that some of you are first years. I wish I had known as a first year that I didn't have to go to New York, that I could have gone and been the Corp Dev VP at Callaway Golf and made like 120 and lived in Coronado. I would not be talking to you right now. I'd be on the golf course. So this is good, just to like play around with like, well, what if I did take that job at whatever? And then some case study resources. Again, use Street Easy, residual income, stuff like that. And then your biggest resource, I would say, is me. You can text me anytime. Well, let's go through the rest of these questions. All right, best first kind property to buy. So it depends on what your appetite is, your risk appetite. So me, I deal with debt all day long. I can tell you, if I was single, I would try to get the biggest multifamily I could possibly get that meets that limit of like, what is my rent going to support? In the New York area, it was like that $3.3 million example I gave, where I'm instantly cash flow positive on day one. If you're a family person, buy a house that your family's gonna be in for a little bit. Like, I can tell you personally, I assign a value to what it means to me to not have anyone have ownership over the house that my children are in. Because I had a personal, and my wife and I were on active duty in DC. While I was out, she was on active duty in DC and I was commuting back to Wharton. We had a 6-week-old baby, and our landlord in DC tried to kick us out of our house, middle of COVID. I wanted to fucking kill that man. And long story short, I ended up suing him, winning, and getting a settlement. That settlement amount was about $4,000 a month for the time that we lived there. And that is what I legitimately used when I was like, okay, what is it worth to me to not rent in New York City now that we go? And I assigned $4,000 value. The other thing when you're looking at this is sunk cost, your like throwaway cost in a purchase is interest, taxes, and insurance and association fees. Your principal appreciates at the same value the house does, which for me in Greenwich has been like 10% per year. Sweet for me. Other places it might be 0. Like, so you just have to factor that into, like, you can do a net present value calculator as well as I can. Factor that stuff in. And then, yeah, so that's how you kind of develop that, like, what's the property I want to buy? You know, if you bought a house and then 2 years down the road, you're like, we have kids now, or I want to upgrade, whatever, you can refi that existing property, unencumber your VA loan, and go buy another house with a VA loan. You would, if you don't have disability, you would just pay that 3.3% funding fee for seconds and so on. If you have a VA disability, you don't pay a funding fee. So do your VA disability paperwork. My spouse has student debt and we are not married. Should I leave her out of the loan package even if I want her on the deed? Her income would help to the overall loan value. Let's look at it, do the application, and I don't know who asked the question, but text me after, whatever. If it doesn't encumber your debt profile to the point of you not getting approved, put her in the loan. If it does, take her off. It doesn't really matter. You can do a quick claim deed after the fact and grant someone partial ownership of your home. This would be my third home of the VA loan and my significant other's second. How would we split entitlement? You're each charged 50%. Excuse me. So let's say that you have, so going back to that VA calculator, VA entitlement calculator, let's say that you have $100,000 remaining and he or she has $150,000 remaining. You each get 50% of that entitlement, so you get 50, they get 75, 125 comes together. That number times 4 is your VA no-no. Anything over that, you put 25% down payment. Where to look? You should develop a thesis for what you believe is a good real estate investment. I've told you what mine is. Again, take everything that anyone that says they're an expert in real estate with a grain of salt. Like, it's worked out well for me, but like, you develop it. You're just as smart as I am. Like, figure out what you think makes the market turn in that specific area. Like, I'm gonna pick one. Charlotte, North Carolina, where my wife is from. There's an area 45 minutes north on Lake Norman. There's Mooresville, Cornelius, Denver, Sherrills Ford. What's ironic is Sherrills Ford and Denver do not transact as fast as Mooresville and Cornelius. Why? Because Mooresville and Cornelius are directly on Interstate 70 and you can get to Charlotte in like 30 minutes. They both have great school districts, they both have Whole Foods, so my metrics totally shit to the wind, but it's like actually knowing what makes that market drive, you're gonna be able to then decide like, okay, well, I'm willing to spend an extra, whatever it is, 10% to be next to Interstate 70 so that that house is worthwhile to whoever's trying to commute to Charlotte. So like that's the biggest thing that you can gain from this is like if you're a second year and about to graduate, like you don't have much time if you want to buy a house, but you know, we are the cohort that we can figure out some holes in this market to find some really good deals. If you're a first year, you've got time and you can figure out like what does it look like in multiple markets and then make a decision like, do I want to spend $2.75 million and live in Greenwich, Connecticut, or do I want to spend $1.5 million and live in Carlsbad, California? I know which one I would have done. Would love to hear more about the art of finding the right deal. That is the most exciting thing in my job now, is like helping people find these intricacies of the VA loan. It also is candidly what separates our team from others, because you might not know this, but the barrier to entry into the real estate game is not a degree from Wharton. Would love a copy of the slides. I'll send them out after the presentation. Thanks for coming, thanks for having me, and great to meet you guys. Does anyone have any questions before we go to the happy hour?
Sorry if this is a bad question.
I love bad questions. There are no bad
like,
questions.
at what point do we contact you? Like, where in the process do we get you involved?
Tonight.
Like,
Yeah,
before
so
we've done anything?
yeah, so there is no, number one, you don't pay a fee until you transact. We're a startup, so like we're trying to figure out how to distinguish ourselves other than like a fee, but like if you went to Veterans United, you pay them $3,500. If you go to Chase, you pay them $1,500. So like everyone has to have a fee to transact. None of those fees are enacted until you close on the house. So come to me, we'll pull your certificate of eligibility, we'll look at your credit, make sure there's nothing messed up there, and then and you just go and you start searching. And then you find like the best buyer's agent that you can. Now, it depends on the market. Don't sign any paperwork that says that like you owe them 2.5% of the transaction if there's no commission. Like, don't do that. But if you can get someone who's transacted for 30 years in a market in Chicago, I'm like working with an agent right now on that. This woman has worked and lived and her kids grew up in Chicago. Like she knows like street by street. She's like, oh, that's Susie's house. Like that's someone you want on your team. Like find that person early on. Like candidly, we are, I would say objectively, we're the best VA loan team in the country. Like find the really good person. You have us as the VA loan team, and then you just go out and start searching and start figuring out what you want to do next. Yeah, but really like timeline wise, I would say don't do it shorter than 15 days before you want to close. The quickest loan we've ever closed is 8 days. We have to give VA appraisers 10 days to do their work, but if they can get it done, we can get it done just as fast as they can. So like, don't come to me 15 days before you're closing and be like, hey, can you help?
Or like if I'm a first year.
Yeah, let's, do you know where you're going?
Jersey.
You're going to Jersey? What are you gonna do? Consult. You're gonna have a better life than I did as an investment maker. Good decision. Yeah, so what you could be doing in the meantime is like, you probably have a rough estimate of what your budget looks like. I can help you develop a budget. You can also just use the spreadsheet I sent you, and then you just start looking. And you're like, okay, are you in Jersey City? Where are you doing?
I don't want to live in Jersey City necessarily.
Where's your office? Sorry.
Oh, they have one in Jersey City and Summit.
Is it McKinsey? BCG, okay. Yeah, you could be like, what does it take to transact in Hoboken? And you start watching, and you're like, cool. It seems like houses on, I forgot the name of like the main drag in Hoboken. But it seems like houses on this block are transacting way faster than houses over here. And you start developing that area expertise a year and a half out or a year out or whatever before you're actually ready to buy. So that when you do get to that point, you're like, I've watched 10 houses transact in Hoboken, and I know exactly what makes them transact fast, so that when you see something come up, you're ready to pull the trigger. One thing's very specific to you is you're gonna have to more than likely waive like lots of contingencies, put a lot of cash down, stuff like that, but there's ways to work through that. But that's in the future.
Two quick questions. Thanks for being here, by the way.
Thank you.
You mentioned that you can get a loan that's higher than your bid amount.
Yeah.
Can you use that difference for like say renovations if you're buying a constructor?
That's an excellent question. So, short answer, no. So the concessions I spoke about have to be used for the transaction fees of the deal. What you alluded to is something called the VA rehab loan or VA renovation loan. So let's say you're approved for $1 million. You find a $900,000 house and it needs $100,000 of work. We write the loan for $900,000, or rather we write the loan for $1 million, pay the seller $900,000, and then put $100,000 in an escrow account that then pays out a contractor. And you pay like a percentage point higher than the market. But that's an excellent deal because a construction loan on the flip side is like on the regular market side is probably like 10+%. And then after the fact, you could refi based on the new valuation of the house, take cash back. There's lots of things to do there. It's pretty cool. Does that answer your question?
That answers my question. And then the second question, you didn't touch on it about, can you talk a little bit about like assuming someone else's VA loan and how that process works?
Thank you. That's a great question and something I really meant to talk about. Please, for the love of God, do not let anyone ever assume your VA loan. Because here's what happens, is let's say I take David's VA loan, I now have his entitlement, and I'm a total dirtbag, and I don't ever pay my mortgage again, David's entitlement's gone. Like, that's it. So if you can get, but like, I would never advise you guys to sell out unless they're willing to pay you something ridiculous. Like, you do some net present value calculation, and you realize, the other thing is you If that person doesn't refi out of the VA loan, you can't ever use your VA loan again. Like the full power of it. It comes back to the county loan limit, but if you're going to assume a VA loan limit or a VA loan, it's a pretty awesome thing. But let's say that let's say you're buying a $300,000 house. It's got a 2.5% VA loan, and it's got $260,000 remaining on the loan. You would have to bring $40,000 cash to close. That's not a big number. But
You can bridge that with another loan?
yes, you can. It counts towards your DTI. But if you went and you could even do stuff like do a short-term cash loan, and then once you own the house, take out a HELOC. You could do stuff like that. HELOCs generally can go up to 95% combined loan to value. So you wouldn't be able to go greater than what would that be? $285,000 on that house. So yeah, that's like $300,000. That I have seen that more than often. There's so much pay down. You know, like the days of the GPA rates sub 4.0 are kind of over. So the houses that have those, like let's say it's $1 million house, it's probably got $700,000 remaining on the loan. It doesn't necessarily make sense for you to assume it. It makes a lot of sense for a civilian who's already going to pay somewhere between 20 and 30% down payment. But for you, where you can leave, you can put no cash into the deal. Sometimes from a net present value standpoint, it makes sense just to get your own loan. Especially right now, the rates are like 6.5%. And if you do believe the rate market's going to come down, then it's pretty good. Predicting rates is like predicting anything else in the public markets. It's futile. I do think rates will drop as we continue through the election cycle. Not like significantly, right? We're not going to go to like 4.5%, but like right now they're about 6.5%. I think that'll probably continue, and that's a pretty decent rate. Does that answer the question? Yeah. So yeah, try to assume them, but don't ever let someone assume yours. Is the short of that.
I think I know the answer to this question, so it's probably pretty dumb, but I just want to check. So my boyfriend and I want to buy a house in a place that we won't be able to live in for like 4 years because I'm still active duty and I'll have to finish my next tour out before we can move there. There's no way we can use any aspect of anything from the VA that would help us buy a house.
What is the relationship with the person that you're buying the house with?
We don't know that. It's nearby.
No, I'm sorry. Did you say you're engaged?
My boyfriend.
Boyfriend.
Yeah,
Okay.
we're gonna be engaged, but like.
Got
he
it.
also has the VA loan, I would have the VA
So
loan, but we don't want, we can't live in the house for like 4 years, so we wanna buy it, rent it until I get out of the Navy.
Is he on active duty still?
He just got out.
Perfect.
Okay.
So if you're married,
Yeah.
your VA entitlement can convey to your partner.
Mm-hmm.
So I just did one for an active duty guy. The world gets really small if I get specific, so I'm just gonna make this broad scale. He's stationed in one state, his wife is moving to another state for work. She's a civilian. He's active duty. She is using his VA entitlement to close on the home in the new state, and he's not gonna be moving for like a couple years.
Oh.
Yeah, so that's very possible. Is your spouse?
And then just he would have to live there?
He would have to meet the residency requirements of the property.
But just him?
Just him. And then, and if there's like nothing saying that he can't travel and come see you on active duty, right?
Yeah, he just has to.
Yeah, you just don't put it on Airbnb.
Enough to sit there.
Yeah, just don't stick it on Airbnb.
Yeah.
And if you do, just obscure the property address and don't ever tell me. And then property, same deal, 1 year, and then you can move. But where are you guys thinking about buying?
We want to live outside, we want to live in Frederick, Maryland.
Oh, cool. Yeah, that's a good spot. There's the only stipulation there is you guys have to be married. If you're not married, then he could buy it, presumably because he could live in
his entitlement and
Correct.
just his.
in just his salary. But the only way to combine your salaries, and you would only use one of your entitlements, like it doesn't matter between the two of you, but we'd use one of your entitlements, both your salaries, buy the house. He would meet the residency requirement.
Okay.
but you have to be married, so.
Sweet.
Anything else, guys? All right, well, let's go to Happy Family.
Thanks so much.
Thanks for having me.
Thank you.